In March 2020, in London, Amelia Hart, 37, chief accountant at a logistics company, opened her bank app at 6:12 a.m. The number was still there, £286,400. Cash. Deposits. What she always called absolutely safe. At 10:47 a.m. that same day, an email arrived from the company's finance department: cash withdrawals are temporarily closed. We will update you when the market stabilizes. Not because the bank had gone bankrupt. Not because she had made a mistake. But because the money market, where financial institutions park money overnight, had suddenly become paralyzed. In a crisis, what disappears fastest is rarely the asset considered risky. What disappears fastest is often the asset thought safe, because everyone is on the same side of the belief. And when the crowd realizes they need an exit all at once, the exit suddenly ceases to be an exit. In today's video, we'll explore 8 seemingly safe assets that disappear the fastest. Disappearing here doesn't just mean a drop in price, but one of 3 states: loss of liquidity, loss of access, or loss of real value so quickly you can't react. These 8 assets aren't grouped together because they're similar. They're grouped together because they share a common foundation: belief in a protective mechanism. And when that mechanism is overloaded, safety turns into an illusion. The first asset often disappears in the most shocking way because it's at the heart of life: deposits and cash in the banking system. It sounds illogical. Deposits can't disappear. But in a crisis, the risk isn't just nominal loss. The risk is not being able to withdraw when needed, or being able to withdraw but losing real value because inflation erodes it week by week, month by month. When confidence falters, money leaves the system faster than it can handle it. And then, money still exists, it just no longer performs the function you expect, transforming into goods and offering immediate freedom of choice. The second asset is what people often call safe bonds. In normal times, high-quality government bonds are a safe haven. But in liquidity shocks or inflationary periods, bonds can depreciate very quickly in ways few are prepared for: not immediate default, but a price crash due to soaring yields, or negative real yields, turning safety into planned loss of purchasing power. When interest rates reverse, what was safe in the past can become the fastest falling asset in the present. The third asset is the modern kind of safety: money market funds/cash substitutes. They are sold as upgraded cash, high liquidity, low risk, and better yields than bank deposits. But in a crisis, the risk lies in the fact that they rely on smoothly functioning capital markets. If the short-term financing market becomes congested, upgraded cash can be shut down, withdrawal limits imposed, or revalued in a way that shocks holders. The fourth asset is a symbol of the middle class: well-located real estate. Everyone knows that property prices can fall, but what makes it disappear so quickly isn't just the price. It's liquidity. When credit is tightened, buyers disappear. The asset remains, but it's no longer a flexible financing option. It becomes a concrete block tied to debt obligations, taxes, maintenance, and the selling price is sometimes far lower than you think it's worth. The fifth asset is the stock of large financial institutions, which many consider too big to fail. History shows that in credit crises, the group most quickly revalued is the one with the greatest leverage. Bank stocks can evaporate not because revenue disappears, but because if confidence in their solvency is questioned, their market capitalization will be wiped out by the market before the financial statements have a chance to reflect it. The sixth asset is the retirement fund and the age-based safety portfolio. Many believe that an age-based risk allocation system will protect them. The closer to retirement, the safer. But if safety is built on the assumption of perpetually low interest rates or an uninterrupted long-term bull market, then in years of high volatility, the portfolio value can decline faster than the ability to work to compensate. It disappears in the sense that you no longer have time. The seventh asset is the domestic currency during inflationary shocks/import disruptions. The domestic currency is still considered the default. Salaries, taxes, spending are all in it. But when inflation gets out of control, the money isn't lost because it's confiscated, but because its store of value disappears. And it happens so quickly you feel like you're chasing a falling elevator. The eighth asset is the group labeled low risk but is the most fragile when the system is under stress. Products with hidden leverage, from investment-linked insurance, structured products, to instruments designed to stabilize yields. Normally, they run smoothly. In a crisis, triggers appear: margin calls, rebalancing clauses, price spreads, market closures. And safety disappears in a single session. The common thread among all 8 types isn't their names. It lies in a very cold statement: safety isn't a fixed attribute of an asset, safety is a state of the system. When the system is running smoothly, most things look safe. When the system is under stress, the first things tested are those you trust the most because you haven't prepared a fallback plan for them. If you dig a little deeper, you'll see that the fastest to disappear isn't a random characteristic. It's the consequence of a very specific psychological financial structure. The safer an asset is perceived to be, the fewer people prepare for its worst-case scenario. When people believe bank deposits are absolutely safe, they hold all their liquidity there. When government bonds are seen as risk-free, investment funds and banks pile them up on their balance sheets. When real estate is seen as a defensive asset, buyers are willing to borrow as much as possible. The concentration of belief creates a concentration of risk. Under normal circumstances, this isn't a problem. But when a liquidity or confidence shock occurs, everything moves in the same direction. And it was precisely that prior absolute consensus that made the adjustment process so extreme. Let's look back at bank deposits. In stable conditions, the banking model operates on the principle of partial reserves. Short-term deposits are used for long-term loans. The system is only sustainable if not all depositors withdraw their money at the same time. Trust is the foundation. But when trust is questioned, even by a rumor, a loss report, or a market fluctuation, withdrawals can increase exponentially. Digital technology has made this process much faster than in the last century. In just a few hours, liquidity can be withdrawn on a scale that previously took weeks. Here, the asset isn't lost because of immediate bankruptcy. It disappears because its convertibility into a means of payment is interrupted. With government bonds, the mechanism is different. They are considered the foundation of the financial system, used as collateral in countless transactions. But when inflation rises or interest rates adjust rapidly, bond prices plummet. If the institutions holding them have to record unrealized losses, their equity is eroded. As capital dwindles, they are forced to sell more assets to meet capital adequacy requirements. A new cycle forms. Real estate operates on a similar mechanism. Prices reflect not only physical supply and demand, but also access to credit. When banks tighten lending, the number of eligible buyers drops sharply. A booming market can freeze. The asset remains, but its ability to convert into cash, which determines its real value in a crisis, suddenly diminishes. With pension funds and age-safe portfolios, the problem lies in their long-term structure. They are designed based on the assumption of average returns over decades. But crises are not evenly distributed over time. If a shock occurs precisely at the end of a generation's labor cycle, the losses cannot be offset by market time. What seemed like long-term security becomes fragile due to the timing factor. Domestic currency carries other risks, inflation and capital controls. When the government faces debt pressure or a foreign exchange crisis, policy can change very quickly, from adjusting exchange rates and restricting remittances to implementing transaction controls. In those circumstances, assets don't disappear physically, but their use is restricted. Complex structured financial products have one thing in common: they usually function smoothly under normal conditions because their pricing model is based on the assumption of stable liquidity and volatility. When volatility exceeds a certain threshold, the product's inherent protection mechanisms can activate in a way that is detrimental to the investor. It's worth noting that most of these assets don't disappear during periods of growth. They function perfectly. It is this prolonged perfection that creates the illusion of sustainability. And when the shock comes, the first thing to collapse isn't the high-risk asset. It's the belief that some assets are immune. History shows that in every monetary cycle, there is always a group of assets that are elevated to the status of absolute safety. And it is this same group, when challenged, that creates the biggest psychological shock to the system. Because when risky assets fall in price, people consider it normal. But when safe assets disappear, confidence in the entire structure begins to waver. And that is the starting point of a deeper adjustment phase. Looking back at the major turning points in financial history, we will realize a cold rule: each period has its own safe haven, and each of those havens has been tested by fire. At the beginning of the 20th century, European government bonds were seen as the pinnacle of financial safety. The middle class across the continent held Tsarist bonds, believing that such a vast empire could not possibly default. After the 1917 revolution, those bonds became worthless paper in a single political decision. There was no gradual decline. No long-term warning. Just a declaration, and the safe asset vanished. In Germany in 1923, savings in marks were seen as a stable foundation after the war. But as hyperinflation accelerated, prices changed daily, then hourly. People went shopping as soon as they received their paychecks because a delay of a few days could have their purchasing power. The asset wasn't confiscated, it was eroded to the point of becoming unusable. Japan in the late 1980s believed that land in Tokyo was an unfallible asset due to limited supply and its global economic standing. When the bubble burst, commercial and residential real estate prices plummeted for over a decade. Safety didn't disappear in a week, but it lost its real value faster than a generation could adapt. During the 1997 Asian financial crisis, many businesses and banks considered national pillars were affected. The domestic currency being pegged to the USD created a sense of stability. When foreign exchange pressure erupted, the exchange rate broke, and foreign debt ballooned overnight. Balance sheets that were once considered healthy suddenly became severely unbalanced. And in 2008, the U.S. stock market, especially bank stocks and large financial institutions, was once considered too big to fail. But the market capitalization of many large institutions fell by more than 70 to 90% in just a few months. Some disappeared through emergency mergers. Some were nationalized. Systemic safety turned into systemic risk. It is noteworthy that in each of those examples, not all assets were wiped out. Only those assets most heavily reliant on the confidence structure and leverage of that era collapsed the fastest. Belief in the empire. Belief in the domestic currency. Belief in the financial center's real estate. Belief in fixed exchange rates. Belief in the invincible bank. When that belief is shattered, the speed of adjustment far outpaces the speed of reason. And here a recurring pattern emerges: the assets considered safe are often the most heavily accumulated. When a shock occurs, the large volume of holdings causes a systemic adjustment. Panic stems not only from financial losses, but from a sense of disorientation. Because safe assets are not just investment tools. They are symbols of stability. When that symbol collapses, the psychological order is shaken as well. The current cycle does not necessarily repeat itself in the same way. History does not repeat itself exactly. But it repeats the structure: accumulating leverage, overvaluing assets, reinforcing collective confidence in a group of immune assets, and then challenging that confidence with a shock. And when the challenge occurs, what disappears fastest isn't the high-risk asset. It's the feeling that something is truly unbreakable. That's the most dangerous moment in any monetary cycle. Ultimately, when we peel back the layers of history, data, and mechanisms, what remains is not just a list of 8 asset classes. What remains is a fundamental question about the nature of safety. In the modern monetary system, most assets exist thanks to confidence standardized by laws, policies, and market mechanisms. Bank deposits are safe because they are insured and supervised. Government bonds are safe because the state has the right to collect taxes. Real estate is safe because the need for housing is permanent. Pension funds are safe because they are designed for the long term. But all those layers of protection depend on one prerequisite: the system must operate in equilibrium long enough. When leverage exceeds its capacity, when valuations far exceed real income, when policy has to choose between asset stability and monetary stability, that equilibrium begins to crack. Safety, then, is no longer an inherent property of the asset. It becomes a variable dependent on the power structure and policy decisions. And this is the point many overlook: assets don't disappear because they are weak in themselves. They disappear because the structure supporting them changes. Treaty bonds weren't weak until the regime changed. The German mark wasn't worthless until monetary policy spiraled out of control. Japanese real estate wasn't useless until credit contracted. Bank stocks in 2008 didn't lose their economic significance until interbank confidence collapsed. The structure changed first. Prices adjusted later. And when structures change faster than the public can perceive, adjustments can occur at a speed that turns safety into loss in a very short time. This doesn't mean that all safe assets will collapse. History isn't a prophecy. But it's a map of how systems react when pushed to their limits. Each monetary cycle creates a characteristic illusion. There are times when gold is believed to be invulnerable. There are times when governments can control every cycle. There are times when technology eliminates risk. And in each cycle, a part of that belief is challenged. Perhaps the deeper question isn't which asset is safest, but rather, what conditions does safety depend on, and are those conditions sustainable? Because in a system based on credit and trust, every asset is a reflection of the underlying structure. When the structure is stable, the asset is stable. When the structure shakes, the first things to shake are usually the things we least suspect. And that's where the historical cycle continues to turn. No fuss at first. No flashing red lights. Just a slow shift in the foundation until the pace picks up enough for people to realize that safety is never absolute. And when trust shifts, the market shifts with it.